Welcome back to Real Estate Mindset. Today's video is going to be extra special for you guys. Today's video, I have a special guest, a dear friend with us today, you guys, Jennifer Rader. Jennifer, how are you this morning?
I'm good. Travis, how are you doing today?
I'm doing well this morning. Thank you for joining us today. So this morning live, y'all, is a little bit of a special live. So it's going to predominantly be basically fielding your questions. So if you're a first-time homeowner or even a potential future homeowner, we're going to do the best we can to help answer any complicated questions you may have. So we'll stick away with certain market analysis and things like that, kind of stick to, how to purchase. And Jennifer is actually a loan officer. I've known Jennifer. How long have we known each other, Jennifer? 7 years, is it? 7, 8 years?
Yep. 7.5 years.
Yeah. So Jennifer, and you guys, if you have any questions, you want to reach out to Jennifer, her contact information is in the description. But let me tell you real quick why Jennifer's here, why I enjoy working with her. So, basically it's really hard to find a loan officer, y'all, that is a genius, but it's also gentle and not a maniac. Okay. So, and you know what I'm talking about, Jennifer. Usually like these genius loan officers are like a hot mess. And I was one of them, so you know that for sure. So I like Jennifer because she's very gentle. She's able to relate with a client. She's not pushy, but she's an absolute genius when it comes to guidelines. So we'll start taking you guys' questions here in a minute. But let me do real quick, Jennifer. I want to show the viewers real quick just a little bit of a market update. Since the market did open, let me throw this up here for y'all real quick. So here's the market open, guys. Everything's about flat, so a little bit up, a little bit down. Gold's still above 2,000. Silver's down a little bit. Crude oil's up. Let me show you guys the 10-year real quick. So the 10-year is down slightly again. Now, you guys remember my live yesterday, I said probably rates would update to 6.65? So rates actually updated. And again, that's just an average. Good credit, 6.67. I also wanted to show you guys this. I'm going to do a video on this later. I thought this was really cool. You guys know how much I've been saying, the rich are going to kind of lead the housing market crash, and the rental market's getting hit, flippers are getting hit, open doors possibly, is at risk of bankruptcy. So this is a really good article I'll report on a little bit later, but this is basically saying investors are losing money on 1 out of 7 homes right now. And we're still not out of the ballpark, right? And this is lagging data. So this is the highest share of loss for investors since 2016. So things are not okay in a lot of areas. You don't have to talk about that, Jennifer. I just want to do a quick market update. I know you're here for the loan stuff and the guidelines. I'm going to get to that. But I just wanted to show the viewers. And then, here's the updated interest rates, guys. I'll do another video, but it did tick up. Basically, we're right here. Okay, this is where we're at. We're in between 6 and 7%. I mean, we've been in that range since September of 2022. So since September 2022, 6 to 7% interest rates. That's that's 2 to 3 times higher, 2 to 3 times higher than what we were at. So that's a quick market update. A couple more people are logging online, Jennifer. I'm so sorry. I'm a little bit getting sick as well. I'm just kidding. Not getting sick. This is just allergies. Or maybe I'm just nervous. I don't know. I'm just nervous. So, y'all, this live is dedicated to all of my viewers. This is going to be completely for you guys. And let's start it off if we can, Jennifer. And you guys start asking some questions. I'm going to start starring y'all's questions. I'll throw them up on the board. We'll do the best I can to answer that. Now, again, remember, Jennifer is a loan officer. Jennifer, let's start this off by tell the viewers what you and I have been doing for the last 6 months. Okay, because they don't know what I go through, right? They don't know what I go through on the front lines with you. Tell them how many realtors that I've tried to train.
Oh my gosh.
Part of in the last, just you and I. Obviously, I help 30, 40 loan officers?
At least. Yeah. So we've been going on the road to a bunch of different real estate offices, and Travis has been doing his YouTube class as well as our social media class. So we go there, we do the class, high energy, and then we wind up doing videos for the agents for their business cards. So it's been quite a trip. It's been really busy for the last 6 months.
Yeah. All right. I'm just going to throw us up. We'll start taking the questions here, but y'all, I got some blowback, Jennifer, yesterday. I put a video out about the new program that's designed to hurt people with good credit. And I came across political, and I really dang it. I still stepped in the mess, and I was trying not to, and I offended a lot of people. So if anyone's watching, I'm really sorry. I didn't mean to get political. I was just really upset that I'm being penalized because I have great credit. So vital signs is should I stop paying my bills so that my credit goes down and my loan's cheaper? No, No,
No, no, no, no,
right?
no. Don't do that.
Because you're going to get additional fees. It's just one area of fees, which is basically a pricing adjustment. But let me throw up a first question here. This is from Don't Move to Texas. He's a longtime viewer, very, very supportive. And he has a question, Jennifer, about the Texas Veterans Land Board, TVLB. Can you go into what it takes to qualify? And will you mention the pros and cons being lower interest rate, higher closing costs?
Yes. So the Texas Veterans Land Board is actually not a loan. It's in addition to any loan. So you compare it with a VA loan, a conventional loan, FHA loan. It's not the actual loan. It's just a program on top of it. So as long as you're eligible for it, then you get the lower interest rate. But you're correct. The fees on it are very high. So sometimes, and probably hate to say this out loud, but sometimes rather than actually doing the land board loan on top of a regular loan, we'll just use the fees that you would normally pay to the land board and just use that to buy your rate down. Sometimes that's a better solution depending on the person's situation. But yes, in general, it's just higher fees. They have very high closing costs and a much lower fee. And much lower interest rate. And they determine the rate every single week, depending on your level of disability or not having a disability.
Yeah. I mean, it's a program that helps a lot of people, but one of the disadvantages is the closing cost. Is it 2% charge or is it 1%?
Yes.
2%?
It's a 2% charge plus your regular closing cost. So it's a pretty hefty fee.
Yeah, it's a hefty fee. So it's kind of like if you hold on to that mortgage for like 5 years, it starts to be worth it. So I hope that answers that question. Here's another question right here. You may not know about this, and I actually confirmed. I went onto our website, and one of the first emails that I saw, Jennifer, about the new credit score tax was an email from Tom about it. I was like,
me too.
I was like, I don't need to see anything. I mean, it's like it's all. I mean, we have the advantage of you guys like my vest. I'm wearing a vest right now. I didn't realize this button was popped open. Sorry about that. It's a little tacky. Anyways, so here's the thing. Someone's asking, is the new credit score tax to be assessed against all mortgages? Now, here's the thing, Jennifer, you may not know that. When I read it, it mentioned federally backed mortgages. So to me, that's eliminating conventional. It reads as if it's only going to be FHA, VA, and USDA.
That's the way I read it too. Yes. Sorry, I didn't mean to interrupt you, but yes, that's the way I read it too, just federal mortgages. And it hasn't started yet. We don't know when it's going to start.
May 1st. So it's supposed to start May 1st. And like a week and a half is pretty messed up. So we're both in agreement right there, y'all. We'll get you guys more info. We have the latest info when it comes to loans. So I don't think that's pertaining to conventional. So Kim, let's see, Kim, good morning, Kim. My son will be looking in Pearland soon. Jennifer, do you live in Pearland?
I do. I live and work in Pearland. That's where I am right now in my office.
You're in Pearland right now. So Kim, if you have questions about loans or if you want to give your son a head start as far as the financing, contact Jennifer. Her info is in the description. She's in Pearland. Now, Jennifer, you know that I'm not telling people to buy right now. I'm being especially cautious, but I'm not so foolish to not understand that some people have to buy or they buy for different reasons. I just think that right now is very dangerous and people should have a more cautious approach. All right. Do you know where Missouri City is?
I do.
Is that a good spot to move?
Oh, yeah. Yeah. Actually, Missouri City, a big part of Missouri City is part of our, and I don't know if we want to talk about programs yet, but it is part of our 100% program. We have a special program for specific census tracts all over the Houston area. And there's a huge portion of those in Missouri City that qualify for the 100%, meaning the buyer does not have to put money down if it is a primary residence. And there's no PMI on it, and the rates are actually lower than market rates. So if the property qualifies and the buyer qualifies for a conventional loan, it is something that we could look at for them.
And a lot of people don't realize that those first-time homebuyer programs have been around forever. Like there was a Dream for California program or something, which, by the way, they ran out of money in the first month. But I try to tell people like this is nothing new. I mean, these programs have been around for a while. And one of the things I find interesting about those programs, Jennifer, is the fact that it has the highest default rate. Why do you think that is?
The 100% programs or the down payment programs?
Yeah.
Because they don't have the skin in the game. They don't have much to lose. If they walk away from the house that they put no money down, they maybe paid some of their closing costs. They have no risk to walk away. They're not losing anything. Where someone who's put 20% down or some larger number, they're going to lose all that equity by walking away from that mortgage.
Yeah, I agree with that. So I have a question from Johnny right here. His question is for people looking to buy multiple rentals, how does one get approved for multiple rentals? And I think what he's saying is Talk about how to offset the mortgage from DTI based on a future rental income or securing a contract before closing.
Yes. So qualifying for the multiple rentals is not much different, except we go into it knowing you're going to purchase more than one. So we're going to do all the numbers based on however many properties you plan to purchase. And we can use the proposed rental income for the properties that you're purchasing. So we do an appraisal, and in that appraisal, we get rent schedules that show what the average rent is for that area. And we use a certain percentage of that proposed rent to offset the mortgage that we're starting with the new house. And we can do that on all those properties.
Now, other than a rental analysis from an appraiser, how do you guys verify, like, do we need a rental contract signed in place to offset that?
Yes.
So you do have to have the tenant doesn't have to move in. You just need a tenant to sign a rental contract, and then it offsets that liability from DTI.
Correct. If we need to, right? We
Right.
have people who purchase investments all the time that don't need to do that. They don't need to have that offset. Of course, once you get into more and more properties, you may need that because you have so much more debt. But a lot of people will qualify without that as well. And we'll look at all options when we go into it.
All right. So, I hope that answers that, Johnny. Basically, you can buy rentals and offset most of the expense from your debt to income ratio, which is a qualifying tool to determine your eligibility by doing a skeleton lease. A skeleton lease, okay, is what people call it. Here's another question. I don't know what's going on with your light. Is your light
I don't
flickering or
either.
what?
I just saw that too. I have no idea what's
You
happening.
raving? You raving out there?
Got nothing going on in the room. This is weird.
Jeez. Okay. Spooky. All right. Is the TDHCA program worth it for first-time home buyers?
Yes. So TDHCA and TSHAC, which is TSAHC, are very similar programs, and they're all over this area. Forgive me, guys. I'm getting over a cold, so it's hard to talk sometimes. They're both very good programs for the for the area. And again, there's a trade-off, right? The programs give you either a grant or a silent second lien to help you with your money at closing, but they give you a higher interest rate, so you pay more over time. So as long as you're good with the trade-off, then it's a great program to do, especially for our first timers who may not have a whole lot of cash, or they have the cash, but they want to hold on to it because they need furniture and things to start up the house and, different things that a first timer would have. So they're really good programs to get you in with less money down.
Yeah, good points. Good points there.
Pocket, I would say.
And also, give them a little bit of warning about how the bonds work. Which one? The grants you get for free. The bonds have restrictions. A lot of the restrictions is like, if you do anything differently with title, refinance, move, the entire amount is due.
Yes.
Is that correct?
We actually don't do, well, there's really three. There's the grant, there's the second lien, and then there's a bond. We actually don't do the bonds because there are too many criteria like that most buyers don't like. So we'll do the grant, which is basically free money. Right now, TSHAC doesn't even have the grant available, right? Because rates are where they are. So they don't even have the grant. So what we're doing is the second lien. Yeah, but it's a silent second. So what that means is, let's say you're going to do you chose the 5% option and they're giving you 5%. The lien would be 5% of what your loan amount is. That is tacked onto your house as a second lien. So your mortgage is the first lien. That is the second lien, but you make no payments and there's no interest on it as long as you stay in the house for 3 years. If you move or refinance prior to 3 years, then there's a prorated amount you have to pay back. Okay. So let's say you decided to move in 2 years. That's okay. You're going to sell the house, and then whatever remaining balance of that lien is, it just gets paid off from your proceeds.
Yeah, I mean, so in other words, you got to be careful what first-time homebuyer programs you get, because not all of them are like a slam dunk. A lot of them you can actually potentially pay back. So be cautious. Here's a great question actually from Jeff. It's basically has to do with house hacking, Jennifer. And if you guys don't know what a 203K loan is, that's an FHA loan that gives people money to rehab a property. Honestly, if I go back in time, Jennifer, before I had 4 children, I would do that. I can't do it now. I got 3 kids here. My son's obviously Boise, but I can't do that now. I can't take those risks. I mean, but if I could go back, house hacking is great. Can you go into the FHA 203K rehab loan and talk about what restrictions are there, how the property passes the occupancy, and then how the homeowner draws from escrow for rehab?
Okay. So it's kind of like a mini construction loan, in my opinion, where you have a plan of what your draw schedule is going to be based on the improvements you're making for the house. Now, there's a simple 203K, which is under $35,000 in repairs, and then there's another one that's over 35. And then you have to have that schedule to know, okay, whatever, 2 weeks in, I'm doing a draw of X amount of money, so I can do this, do this, do this. Then you pass that inspection. Then you go on to the next stage, which is, okay, you're going to do cabinets and flooring or whatever it might be. And then you pull out the money for that. And then FHA and HUD comes in and they do inspections to make sure those things are done. So it is a really good concept and it's a really good idea, but it is quite restrictive and it is costly, right? Because you have to pay for every single inspection that HUD comes out to do. You have regular closing costs, and of course you have the renovation rolled in. You also have to have a contingency on it. So I think it's 10% contingency in case, everybody knows with construction and renovation that things go wrong and you find different things that you have to pay more money for. So there's a lot of restrictions like that. I'm not quite sure what you're asking on the occupancy side though, because FHA is only for primary residences. So you're going to be moving in at some point anyway. So I'm not quite sure what the occupancy question is.
I think it's more livability, right?
Oh.
Like the condition of that's how I took it. I don't know. Is there livability conditions on the 203K because it's a rehab loan? So you would think that it would be less restrictive than a normal 203B FHA loan.
Yes, because you're not moving in right away. The intent of the 203K is to take a house that's not ready to be moved into and to get it ready to be moved into or change the inside or whatever it might be. So they know you're not moving in right away. So it's, again, like kind of the construction. Once you're finished with it, you get a final inspection to show it is livable, and then you're free to move in and do what you need to do.
So it's a really good loan, to be honest. I mean, it's a really good loan. I'm going to answer this real quick. This is Wolf. He lives in Phoenix. He's been tracking all the new construction there. I love this guy. Now I'll answer this. Would I pay cash or a mortgage on my home? Well, if it depends how much cash I have, and it depends on what my goals are in the future. If I had all cash right now to pay off a home, which I don't, I'm not a rich person, but if I did, I'm not going to pay all cash for a home. I'm probably going to just put 10% down, paying all the PMI up front. And I'm going to hold on to, personally, this is what I'm doing. I'm going to hold on to my liquidity because I'm going to invest in real estate for the next few years. That's my goal. That's why I'm sacrificing. Jennifer, you know the sacrifice I'm at. You know how much I'm a wreck and how hard I work. I mean, I'm working so hard right now, y'all, and I'm sounding the alarm because of the future. And I'm putting my money where my mouth is. I'll shut up about it. But let me throw up this other question, Roy. So this takes effect May 1st. And people can't say no. This has to do with the credit. And it's a risk to the pricing. It was hard for me to explain how that works, but you understand what I'm saying. So they're going from a quarter hit to pricing, Jennifer, right? If your score, they didn't tell us the tiers of FICO scores, but if your score is above 780, and again, I don't know what the tiers are, but if it's over 680, their pricing adjustment goes from a quarter to 100 basis points. They increased the fee 75 basis points for good credit. And they reduced the fee for like 620 credit. It was, I think, 375 basis point on the pricing hit. They reduced it from 350 to 175. So anyways, it's just so crazy. Anyway, okay, let me ask this question here. You were probably reading it in advance.
I was trying to, but it's hard to concentrate on what you're saying and reading at the same time, so I was waiting.
It's not easy. Yeah, no, doing the lives aren't easy. If someone owns a home with a traditional loan, so say conventional or FHA, and buys a new primary home with the intention, the thing is, he's already Johnny, I love you, but you've already contradicted yourself. It can't be your primary home. And, if you're going to rent it out, you have to live there, I believe, 1 year. Is that correct?
Yes.
Now, let me ask you this, Jennifer. So the requirement, Johnny, is if you have a home, that's fine. You could purchase another primary residence, but you can't turn it to a rental automatically. It would be considered mortgage fraud. But let me ask you, Jennifer, how many times do they send an inspector out to the property to verify that Johnny would be living in the house? How many times is that done? Zero. I'm not telling people to commit.
They don't go out
I'm not saying... I'm not saying commit mortgage fraud, but I'm just letting people know how it works. So let me read this though, just to make sure I got this right. And buys a new primary home with the intention of renting out. With the intention of renting out the original home, but they need to refinance the original home's loan. So here's the thing. Well, yeah. Why would you refinance but say he needs to? I would refinance prior to moving out of my primary residence personally, because if I refinance it after I've moved out, it's a non-owner occupied loan. The terms are worse. Would you agree?
Right. Yes, I would agree with that.
And
But
here's a
to answer his question, there's no reason that you have to refinance the original just because you're trying to get into an investment property,
oh
right? Your
oh
insurance needs and everything are just going to change because it's now not your home; it's going to be a rental. But you are not
yeah
required to refinance that. The whole thing with mortgages is the intent when you purchase.
yep.
So if you're intending to move into it and it turns into your primary residence and you live there for 6 months or 2 years or 10 years, that was your primary. It's okay if you move on from that house to another house, make the new one your primary and turn that into a rental. People do that all the time. And there is not a requirement to refinance that original unless for some reason you need to for some other financial reason.
Solid. I totally missed that angle. Thank you
That's
for
okay.
picking up the slack. This is a good question, and normally the answer would be easy. Normally the normal answer would be conventional, but basically, Jennifer, I'm starting to see in some situations where this is crazy to say this out loud, but FHA in some situations appears to be cheaper as a result of a couple things. Obviously, the interest rates are going up in conventional, but they lowered their MIP.
Yeah, it's only
What is it?
0.55 now.
It's 0.55, right? Yeah.
Yeah.
So they lowered the MIP. So in my opinion, the problem with there's one reason why conventional is a better loan. There's only one reason. The reason is PMI goes away. Mortgage insurance goes away. That's the only reason you want to do conventional. FHA has lower rates, but the mortgage insurance can last forever unless you have 10% down. It lasts 11 years. Still remember. But when you have low credit, like 620, 640 FICO score, and you try to get a conventional mortgage, your PMI is through the roof, your interest rate's through the roof because conventional is heavily dependent on FICO score. So can you give us a few examples, Jennifer, of why FHA would be better than conventional from an affordability standpoint, not a qualification standpoint?
From an affordability standpoint, it would be fitting more to go FHA for someone who has the lower credit scores for exactly what you just said. The PMI is going to be much higher on the conventional. So you're going to cost yourself money in the end by doing that. And the down payment requirements are higher on conventional as well. Now, of course, we do have a 3% conventional, but most people don't use that. You have to meet certain criteria for that. So in general, a conventional, you have to have 5% down. FHA only allows 3.5%. So you can put less money down and then have lower PMI, because on FHA, the PMI is not credit score dependent, where on conventional, every 20 points or so on your credit score, higher or lower, is going to affect that PMI. And that's a huge part of your payment. I have people that, if they went conventional, they'd be paying over $300 in PMI
Yeah.
rather than
Right,
going
right.
FHA. So FHA would definitely be more affordable to that degree.
Yeah, I mean, conventional is like great credit. If you got great credit or 20% down payment, probably conventional. Here's a good question. This is a little bit hard to answer. Overall, it's easy, but if we kind of dig. But anyway, Cindy's question is, and hi, Cindy, good morning. Thank you for asking questions. And you guys, I'm going to get to your questions. I see these questions. You guys have great questions. They're coming up. Should you use a lender in the state where you want to buy, Jennifer?
I would say wholeheartedly yes.
Why?
Because we know the local regulations, we know the state regulations, we know whether we're a community property state versus not. Every state is a little bit different. The general guidelines for every loan is the same, but the state guidelines, are on top of those. So having someone who knows that, knows, and even can quote you properly in terms of taxes and insurance. We
Yep.
see all the time where we're competing, right? We have someone who comes to us and says, okay, I've been approved by whatever, XYZ Lending, who's in California. Well, the estimate that they sent them for the monthly payment is probably $500 too low because they don't know what property taxes are in the areas that we're in. So I would say for sure, yes, local lender is always going to be better in whatever area you're moving to.
Yeah, and I'll add also, you can go visit them.
Yes.
The advantage of like,
Mhm.
can I meet you? Can I go in to talk to you about my loan? It's it's a crazy thing. Society, and I get it, dude. There's just so many bad loan officers and realtors, Jennifer. And I'm not saying you're one. I'm just saying in general. Oh my gosh, I got some super chats. I got to get these. You guys, I just see the super chats. I'm so sorry. I feel like a bad person. I'm gonna pull that up. Let me come back to Johnny. Let me pull up these super chats real quick. Um, oh my gosh, I am so far up on the comments. I'm gonna throw this up. Travis sold my house in August of 2021 and made a bigger profit than any bank that held a mortgage on it, and now renting. Man, I feel for this dude because I'm in a similar situation. And it was in August, but I rented instead of I converted my primary to rental instead of cash out because I was like, what am I gonna do with this money right now? My friends think I'm crazy, and they are losing money in their homes. Oh, thanks. He's just Dude, thank you so much, man. He was just giving me props, dude. These people, I'm telling you, man, I lose sleep because I care about. I mean, do you see why I do what I do, Jennifer? I mean, these people are great
Mhm.
people.
Yeah, no, definitely.
Okay, now here's another one right here. Thank you, brother, for throwing this up here. I'm using my VA loan. Is there any problems with that? Can you go into the VA loans and the benefit? I personally believe VA is one of the best loans. What do you think about VA?
I
And I
totally agree with
understand.
you.
And talk about the funding fee, if you could.
Yes. So I totally agree that VA is the best loan for a veteran in most cases. And there are several reasons for that. Number one, you don't have to put money down if you don't want to, but if you can and you want to, you can. So there's no restrictions that you have to do 100% financing, but it's available, which is a nice option. Again, like before, if they don't have the money to go in, or they have money, they just don't want to use it, keep that in the bank, keep that as your liquid funds, and then use the mortgage to your benefit. The funding fee is a certain percentage that is paid up front, depending on, excuse me, how many times you've used your eligibility. If you are disabled to any percentage under VA guidelines, that is waived. So even if you have just a 10% disability, they do not charge you the funding fee. But even when the funding fee is charged, it can get sizable, over 3.5%, I think, for some of the uses, but it's rolled into the loan. So it's not a fee you have to come up with at closing and pay cash for, like your closing costs. It can actually be rolled into the loan and just financed over the term. So it's not that bad of a fee, in my opinion.
Yeah, I love VA loans. Some of the advantages: no down payment, you get a low interest rate, and you have no mortgage insurance.
No
One
payment.
disadvantage: the funding fee can be what is the upfront? It was the initial is 2.85.
2.15.
It's only they must have lowered to it. I know
I think
subsequent
honestly, I think it's 2.15, but it could be. I think it's
so much
2.15.
so much to remember, but I mean VA loans. I personally love them, and I love how they use residual income. Oh, you helped Eric. Remember his
Mhm.
DTI was like over 60, but the way that, and I love how they calculate qualifying income, residual. In my
Yeah.
opinion, we should do residual income calculations versus debt to income ratio. I want that's a. Oh my gosh, I got some more super chats. I want to answer this question from Johnny, and I'll pull up these super chats. Y'all stop donating, you guys. Y'all get me emotional. But here's a question right here. Question: if someone buys a home cash, then wanted to get a mortgage later to pull out equity, is that a difficult process, Jennifer?
It is not a difficult process, and there's actually two levels to that. So if someone purchased the house cash and they refinance or they want to pull money out within the first 6 months, we consider that a first-time mortgage. It is not considered a refinance, which is really nice. So a little bit different than, sorry, Travis, go ahead.
No. I
Okay.
was silent. I was silently in shock.
Yes.
Don't look at me, Jennifer. Don't look at me. Here, I'll help you. Here, is that better?
Oh my gosh, don't do that.
Okay.
But yeah, so if you want to pull out cash in the first 6 months, it's treated like a purchase. Excuse me. But yes, you can pull out cash at any time. Now, in the state of Texas, which is back to your question before, should we have someone who's local? In the state of Texas, you are allowed to, on a primary residence, pull out up to 80% of the current
Only,
appraised value.
only
Only,
80.
yes, only up to 80%. So we do a brand new fresh appraisal. We see what it's worth, and you can borrow up to 80% of that number, including whatever fees you want to, roll in or whatever you're doing. So you cannot exceed that amount. So as long as that meets your expectations, that's fine. What I will tell you though, anytime anything other than a primary purchase, there are going to be hits to the interest rate. So if you're an investor, the rate will be higher. If it's a secondary home, it will be higher. If it's a cash out refinance, which is what this would be, the rate will be higher. So you want to take that into consideration when you purchase it on whether you should do a first loan when you purchase it versus doing the equity later.
Okay, very good. And I'm gonna we got I see I'm like really high up on the questions. So I'm gonna just like throw some questions up here, Jennifer, to catch us up. But I want to throw oh my gosh. Okay, this is from my man again. Stop, dude. Stop. I want y'all to save your money. I want y'all to save your money. Please save your money. And y'all don't want to see me cry like a little baby on camera. Or maybe they do. They probably do want to see that. I don't know. Do you know I got yelled at by a Lennar rep the other day, threatened to call the cops on me? And then I didn't tell my viewers is he called AMCAP on me and try to have them force me to take that video down.
Oh my
Now, if
goodness.
that's not harassment, I don't know what is. I mean, I could go after these people. And I left out all the OSA violation comments. Anyways, so for my man right here, we won't go into there, but I want to roast those people so hard for calling my people up like that. They Lennar people called my. Anyways, so reminding me that I'm not the only one sacrificing. You're the man, brother. Thank you for that. You're not alone, man. I'm out here as well. I'm sacrificing. I'm qualified. I could buy a house right now. Jennifer's seen my stuff. I could go out and afford a house right now, but I'm not. I'm sacrificing, eliminating risk, increasing my purchasing power like a beast because of the future. The future, you guys, we got to look beyond like what's right in front of us sometimes, right? Within reason. So, brother, I appreciate that. Oh, you guys are throwing up more. Um, I sold made out great. You think Florida will come down in prices? And is it cheaper to build on your own land? Love your channel. Let me answer the first part of this, Jennifer. Thank you for the support. I really appreciate that. You don't have to do that. I would have eventually got to your question, but it means a lot to me. First of all, what I want to say is finally Florida, and I don't know if you know this, but finally Florida is starting to show signs of price decline. That started happening in 2023, maybe a little bit at the end of 2022, but Florida had remained incredibly resilient from the peak from June 2022 on. But now finally we're starting to see prices kind of crumble a little bit, and it's predominantly where it's, and this is interesting, Hurricane Ian hit, like on the West Coast and through that whole little, if you follow the trajectory of that hurricane, it's very interesting to see the relationship between prices. But is it cheaper? Can you talk real quick? And I want to go quickly because there's a lot of really great questions here, and I want to get to them because they're very, very, very good questions. Can you talk about the process of building on your own land and the risk in that? Because if you don't purchase the land correctly, you can mess up your loan. Can you go into that, Jennifer, please?
Yes, I wouldn't say it's cheaper to build on your own land, but what I do like about doing that is the land is your equity, right? Most people pay cash for their land. They don't generally have a loan for it. So when you do the construction side, you already have built-in equity, so you don't have to put more money in. The process is kind of like we talked about the 203K before. We have a draw schedule for however long it's going to take to build it, and the builder pulls out their draws, and they get inspections throughout the way. So, and what's nice about those is that you pay interest only during the construction period, and then once it's finished, then it turns into a regular standard loan, whatever rates are at the time.
And is it a more complicated process than a normal loan?
Yes, it is. There's so much more involved because you have the contract, you have the builder, you have the inspections. It's much more complicated. And we have to approve you for the final loan before they'll even allow you to do construction, because they need to make sure you can qualify for the final product once the house is finished.
And would you say that people should go into that process with thick skin and be prepared to be frustrated?
Yes, I would, because it is a process for sure.
It is a process, but honestly, I think it's worth looking into. A lot of people don't use these special programs because they're a bit harder. That's it. But usually you get rewarded for the harder you work. I got another super chat. Daniel, I really appreciate your support, brother. Thank you for doing that. His comment is I have an 813 credit score. That's great credit. I can put down 20 to 40% down. Should I do 20 or 40? Some people tell me to put 20 so I can get a larger tax deduction versus 40. So I'm going to let you answer this first.
Okay. In terms of the tax deductions, I don't answer those questions because there's so much more involved in someone's taxes than just the mortgage. So I would say before you decide on the 20 or 40, talk to your tax professional, and that way they can advise you on the tax portion. In terms of the mortgage side, what I would do is I would just run the numbers for you on both scenarios and talk to you about what your goals are for now and for the future to know whether you should spend that extra 20 on the house or whether you should invest it in something else or use it in some other manner.
And honestly, when I dig into this, I think that so the only thing that would make sense to me if you put less money down, you have a bigger tax deduction is the interest. So I'm not gonna give personalized advice, but I'm renting right now, so I paid punch taxes this year. I was so depressed on that. But when I was owning, I was able to claim the interest from my mortgage. It was a nice tax break. It allowed me to pay less taxes. So in that aspect, if you put 20% down, then you're going to have more interest payments, therefore potentially leading to additional tax deductions. Now, if it's me, it depends on my life. If I want to retire, if I want to hustle, right? 40% down versus 20% down may only be a difference of $200 a month. So I would ask myself, can I use that money to make more money, or do I want to lock in a lower payment? Very difficult to answer those questions. But overall, I would say right now it's probably a good idea to put, I got to be careful saying this, okay? But well-qualified people putting as little money as down as possible, all right? Because we don't know what's going to happen in the future. What if 1 year from now rates are 3%? So, I don't know. I'm just saying, and then if you're upside down when you refinance, you have that money available to offset it. But either way, that's the only aspect I can think of as far as 20% versus 40%. If it's me again, I'm asking myself, can I do something with the liquidity?
Right.
Because honestly, it's not that big a difference in payment, depending on the loan amount, of course. Let me go back up. I'm going to go back up to there's some really good questions I wanted to cover here. Let me throw this up real quick. How do student loans affect your loan amount? Student loans affect debt to income ratio. Debt to income ratio affects your qualifying amount. It tells the lender how much you can afford. Now, FHA, tell them the rules on quickly if you can. Tell them the rules, Jennifer, on student loans affecting debt to income ratio, FHA versus conventional.
Okay. So then there actually are newer rules, more recent rules. It used to be that FHA would count 1% of the student loan balance as a monthly payment, regardless of what the credit report said, regardless of what the payment structure was. So 1% is huge for some people who have pretty large student loans. It is now down to 0.5%, or if we can prove there's an actual payment and it's on the credit report, we can use the actual payment, which is really nice. Conventional depends on whether it's Fannie Mae or Freddie Mac. They each have their own requirements. Fannie, I think, is still at, oh my goodness, I think it's still at 0.5%. They were also at I think they're still at 1%, and Freddie is at 0.5%. Or again, if we have a payment proof, we can use that instead. So it depends on what type of loan, on how much we're going to count. And then like Travis said, that affects your debt to income ratio, which in turn affects how much you can borrow.
You see this question that Johnny has for me? You see this guy?
That's funny.
It is.
It's a compression vest.
I love him. I love him.
That's good.
All right. Let me throw up this. Okay, so that's student loans. Here's a question right here. I saw a property for sale with the terms that the 3.75 rate can be assumed pending qual from lender terms. How would one sell your home to allow interest rates to be assumed? I'll answer this quickly. There's two styles of doing this. There's one style of doing it, which is illegal, and you're breaking contracts, and the lender can call it due whenever they want. That's more called a what if or as is, or I can't exactly remember the term. But if you want to do it the right way, the buyer has to get approved through your lender. So if it's me and I'm selling my house, I'm calling my lender. I'm saying, hey, I want to sell my house, and I know that it's assumable. What is the process to have the next buyer have it be assumable? But the thing is you have to also be careful, because even if a buyer assumes your mortgage, you could still be liable for the mortgage unless they do a complete release clause, which again is an approval process. So if it's me, no chance in heck I'm letting someone assume my mortgage unless I have a full release of liability, because if they're late, my credit gets messed up. I'm going to just quickly go through this question. Okay. Question. Do you feel the housing market will improve in the third quarter? It depends on your definition of improve. I'm going to just say improve means more balanced and more affordable. And I absolutely do. I think this whole situation, Jennifer, I have to be careful. I'm not trying to upset you, but I think Q3 is going to be very revealing, because in Q3, we'll have our inventory dump. We'll have been through summer. And I think that's like the cat's out of the bag. Once we have that inventory dump, there it is. There's going to be the proof. We're going to see how the market reacts to all the inventory. We'll see if all the buyers come back, and then we can estimate. I find that extremely hard to believe, being that now I think 65%, Redfin article updated this morning, 65% of metro areas are on the year-over-year decline list. 65%. It's just, there's a lot of narratives. We need more data. I get it. Let me keep going. I read that comment from Johnny again. It's so funny. I got another super chat. I'm going to get to your super chat. I see it. Kim, question: with loans tightening, can my son buy his house? Then help me buy mine too. He works for McKinsey, and he has a great job too. I will have a big cash down payment. Hope this makes sense. Yeah, it makes sense. So Kim, again, contact Jennifer. I threw her information up on the screen, but I don't want to come off salesy. I want to come off helping you. But there's only so much we could do on live. So get her information in the description. Call her. Yes, you can have your son qualified, and then you can qualify yourself once you're ready. And then to answer Johnny's question, yeah, man. I mean, honestly, when I have a compression like this, it makes me look more fit in my mind, and it helps me with my nervousness. Thank you, Johnny, for recognizing that. All right, let me keep going down here. Did you get your answer, Jeff? Thank you. I'm going to get to that super chat. I'm just trying to mark. Okay, here we go. I'm going to mark this question, then I'm going to go to the super chat real quick. Jeez, I'm not even past the other super chats. Who threw this up? Oh, don't move to Texas, brother. You don't have to do that, man. I keep telling you. Thank you, man. But from the bottom of my heart, thank you. That gesture means so much to me. You have no idea how important it is for me to give y'all good, valuable content. I have 100% exempt from property tax and PMI. So he must be a veteran. I'm already reading like if he's got to be a 100% disabled veteran. So 100% disabled veteran in Texas, no property taxes. Texas takes care of their veterans. Do the savings for those monthly exemptions factor in retroactively to allow me more buying power? I already know this answer. The answer is 100% yes. It's 100% yes. If you're a fully disabled veteran, the property tax is not counted against your debt to income ratio, and your VA funding fee is not added on top of your loan.
Correct.
Good question. Is that right?
Yeah, that's right.
I still remember. Y'all, when I met Jennifer, I was the number 5 loan officer out of hundreds of loan officers. I was the number 5 loan officer in the entire company, and then I became a branch manager after that. So dude, it is such a hard job, Jennifer. My gosh, it's a hard job, isn't it?
Yes, it is.
All right. I'm doing great work. Love seeing the new vids pop up on my feed. Oh, he didn't even have a question. If you guys are going to throw up a super chat, please, I don't want to feel guilty. At least ask a question. Thank you so much, man. Happy Friday to you. I'm trying to do good content, you guys. I will adjust. Oh, Dooster's in the house. Dooster's here. I will adjust my opinion, and I'm not going to hide from the data. I'm giving you guys my assumptions. I'm linking the data. I'm telling you why I think what I am thinking. And, ultimately it's their decision to decide. But that doesn't mean I don't have, I still get to worry. If I want to worry, I can worry. Okay. And I do worry about Jeff, Vital. I worry a little bit about Johnny, even though he makes fun of me. I think he makes fun of me because of the friendship, right? Or else he just wouldn't talk to me. So I'm coming back up, you guys. I'm looking for some more questions real quick. Oh, so here's someone right here. Oh, you know what? I'm gonna go to JO real quick. I was gonna pull up Rev Nations. So let me just throw this up real quick, but he is all over the place. Let's see here. So JO, now here's this comment right here. Travis, if the banks get real tight in lending, what percentage would need to be put down to get qualified? So this is forecasting. I'm looking to put down at least 50% down on my primary residence next year. I'm comfortable with 50%. I'm gonna be honest, Jennifer. Like, even if all heck breaks loose, which I would argue it already has, and they start tightening lending restrictions, I don't think that they would tighten it so much that it would require a 50% down payment. Like, no. I 10%, I would think would still be ridiculous. But the thing is, Jo, they haven't done it yet. Jennifer, they haven't done it yet on paper. Jennifer, can you go into any credit tightening you've seen while running automated underwriting system during the pre-qualification stage? Can you tell me if you've seen in the last 2 months any credit tightening per se?
Maybe just a little bit. I wouldn't say that we've had any additional guidelines added, like something in addition to what we already have. I would just kind of say that they're being a little bit more strict on what's already there, making sure that we have a certain number of trade lines, making sure they have a certain amount of history. It's going much more in depth in the credit sense in terms of the credit profile than I think we have before. But in terms of guidelines, we really haven't had any additional guidelines added in the last 2 months or so. So I would say credit tightening, yes, in terms of the content of the report, but guidelines, no. And I agree with you. I don't ever see ever see it going to a requirement of 20% or even 10%. I just don't see that happening. They would disqualify too many people, and homeownership is, the American dream. So I don't think that would ever happen. I really don't.
I got some more. Great answer. You're doing really great, Jennifer. I know people get nervous on camera, but you're doing great. I see the super chats. I want to get to those super chats. I want to quickly acknowledge this question. Very good questions this morning. We're doing the best we can. Obviously, we're just normal people that are beast mode loan officers, just so we do have that in our advantage. So when I was doing my pre-approval or pre-qualification or conditional qualification letter, whichever we want to say, it was asking if the home was rural. Rural. Can you say it? Rural?
Yeah, it's a hard word.
Rural. That just is a different way of saying USDA loan. So I'll just answer this real quick. In order to qualify for USDA, the property has to be in an eligible area. In order to find out if a property is an eligible area, just go to USDA's website and then type in eligibility map. So type in eligibility map, put in the address, and if it's in there, it qualifies for USDA financing, which is 100% LTV loan, meaning no down payment, and it has very, very, very low. It's not mortgage insurance. What's it called? A guarantee fee, right? What
Yeah.
is it? Point
Basically,
two.
it's PMI, but yeah, it's a monthly, and they didn't used to have it. It's just in the last couple of years that that's been added.
All right, I'm going to pull up these super chats real quick.
While you're doing that, Travis, just to give a little further on this question, I think, yes, they're asking possibly for USDA eligibility, but I think they're also asking, a lot of rural properties are acreage. And it makes a difference when you're doing a primary loan if you're on a lot or whether you're on 2 acres or you're on 20 acres. So that could be a reason for that question as well.
Good, good. Well done, well done. Thank you for lifting me up there. Okay, I love my R agent, my realtor. Okay, so he loves us. Again, man, you don't have to keep doing that. Thank you, brother. Stop though. I want you to go donate. I want you to if you go to Starbucks, I want you to buy the person behind you some coffee and love them. All right, that's what I want you to instead of giving me $10, go show some sporadic love to someone and watch how that makes you feel. All right, now lately he's been trying to push homes on me, but what he believes they will be worth in a couple years, I tell him pass. Do not be afraid to push back on agents. They get desperate. I'll answer this because I know you're still in the origination. You have to be careful what you say, but yeah, I don't care if you love, like, or hate your agent. You should not be pushed into purchasing the largest transaction of your life because it's all emotional until you close. When you close, all the emotion goes away and you're like, oh, this is my house. I have to pay a mortgage for 30 years. So I'm just going to say, you're going to want to push back. If you don't feel you're getting the right service, do something about it. And that's just my feeling. They get a ton of money. You don't have to comment on that, Jennifer. Deuster, this is my boy right here, Deuster. Deuster, I want to just say this real quick. You're getting smoked on the first comments, man. I think you may have to come back. You're getting smoked, man. We got a new champion. He's like Deuster 2.0. All right. Oh my gosh. Wait, I should be talking trash. She just donated $25. Oh my God, why am I doing that to Deuster? Deuster, thank you. I want to get out to your neck of the woods and go shark fishing with you. Can you? I didn't even read his question. I can touch my nose with my tongue. Yes, I can. I have a very long tongue. Ah, Deuster.
You don't need to watch that, okay?
I'm not going to do it. I'm not going to do it because there's going to be someone that gets offended. There's going to be someone that gets offended. I don't know who it's going to be. Someone's going to get offended. And I think I caught up to all the super chats. I'm going to go and just like hunt down some questions here, y'all. I lost my spot, y'all. Dang it. I lost my spot. Barber. I don't know if they're talking about me, my barber. I don't know. I'm lost. Y'all throw some more questions out at the bottom. I'm just going to start over on the bottom. All right. Because I'm lost here. All right. Okay, I'm all the way on the bottom now. I'm all the way on the bottom. Yes, Deuster, you derailed me. That was a good one. Because I almost did it. I almost touched my nose with my tongue. But then I was like, wait a minute. He wants me to embarrass myself. I'm on to him. So here's should I use my primary residence as a high cash flow investment property when I move or take the equity tax-free and peace run? And I'm going to just answer this. It depends. It just depends on your goal. I did that. I converted my primary into an investment property. It's cash flowing. And even if the property values go down 30%, I'm good because I have around 40 to 50% in equity in my house. I don't need that liquidity. I have liquidity, so I don't need that. And I have a 2.375% 30-year fix. There's no way I'm selling that house unless I have to. Here's a question. You guys, I'm all the way on the bottom now. I'm sorry if I skipped your questions. Ask it again. I had to, out of survival mechanism, I had to just go all the way to the bottom. Question: how does the senior citizen Texas property tax exemption work? Is it under 10K in taxes? You don't pay taxes until it goes. So here's the thing. I'll answer this. It depends on the county, Kim, but there are. Is it called elderly? It's called elderly.
65 exemption.
It's 65 plus elderly. What am I? So there is 65 plus exemptions in Texas, depending on the county. It's going to vary on the amount of money you save in taxes, but it is a substantial break on your property taxes. If you're 65 or older in Texas, generally, at least in the Houston area, you can save a lot of money on your taxes by filing what's called a homestead with the county.
Yep.
Okay, so I think that they're asking, is the Texas VA land board also available in Fort Bend County for new builds. Oh no, that's the USDA. So if it's USDA, it depends if those properties are in the eligibility map.
Yes. And we also talked about the 100% for a little bit, and that's all over too. That's in every, well, not every county, but a lot of counties, and Fort Bend is one of them.
Okay, I'm looking at these questions. Non-financial question: is it better for maintenance and longevity to have a house with brick or siding? Thinking of future cost maintenance. I don't have the answers to that. I don't feel comfortable enough answering that. Do you have any? I mean, maintenance and the quality of construction is vital. I'm not saying it's not vital.
Yeah, I would say for sure quality of construction and all that, having in Texas, a lot of houses are built with 3 sides of brick and 1 side of siding or partial siding. I would say if it's all brick, then it's definitely better. Yeah, you're going to have maintenance on it, but are you ever going to have to replace the brick? Probably never, but you'll have to replace siding over time, so, just as a general, nothing to do with financing at all, but because we don't care. But condition wise, I would say brick is always better.
Good. Okay, so Kim, thank you. And everyone, I really appreciate you. I see everyone. I love you guys so much. Kim, are you allowed to recommend a realtor in the Pearland? And here's the thing, Kim, I am a realtor in Pearland. I am. So I will recommend myself depending on when you buy. Right now, I'm just out. Everyone knows that. Everyone's begging me like, Travis, just get in. People are flying to see me. Jennifer is saying, Travis, just let us get a virtual assistant. I'm like, no, I'm not going to sell leads. I'm not going to do that. I'm not going to do that. If I want to help people, I'm going to help myself. So I'm not helping right now, Kim. But if you wait till later in the year, maybe around Q3, I'm probably going to get back in the business once I believe in it again. I've lost a tremendous amount of money. All right. Can you please explain how loan originators paid? Is there a difference between how you're paid, brokers paid versus? So this has to do with loan officer commission, and it does vary. Generally, loan officer commission is between 1 to 1.5% of the loan amount, and it does vary based on that bank's commission structure. So there's advantages and disadvantages with all three. Personally, I like working with direct lending because it's just, in my opinion, it's a bit of a circus show at brokers. It's a bit of a circus show, but they do have good programs sometimes, like creative programs. How long can I lock a rate in? Also, can I submit all my paperwork to a loan officer and wait for a lower rate to lock in? Yes, but in order to lock in, you generally need a property address. So if you don't know where you're going to live, you can't really lock in a rate. I believe what is our max term? 90 days lock, or is it 120 days?
I think, 120 days with a fee, an upfront fee.
Always.
We do also.
I lost you. She is not going to be happy with that quality of picture. She is not going to be happy with how she froze. Jennifer, I lost you. So it's 120 days. I'm going to text her, guys, try to get her back on here, and I'm going to keep it going. I'm going to say you froze. Oh, there you go. I see you. I see you. Okay, I was about to text you right here. So 120 days about, right?
Yes. And we got disconnected, I guess, for a second. So we do have a lock and look. So typically you don't lock your rate until you have a property address because the rate lock is attached to your social and the property address. We do have a special program called a lock and look where you can lock it now while you're looking up to a certain period of time. But those rates either have an upfront fee, depending on how far out they go, or if they're not that far out, the rate is just higher than what current is. So we would really want to compare and see if it's worth locking it now versus just waiting until you find the property and lock it at that time.
I just read a comment for Elijah. Yes, I'm getting hot in this vest, but not because of the super chats. I'm getting hot because I like to be cold, and it's just like really hot. And I was like, I want to text my wife, like, can you please turn on the AC? I'm dying in here. How did Elijah know that? Okay, if a first-time home buyer can buy a house all cash, do you recommend buying all cash? Isn't there more benefits to finance the house, like tax benefits? I'll answer this quickly. Most first-time home buyers don't buy all cash, but like my man Jeff, he could do that. I'm going to again, it just depends on your goals. Right now, I believe we're in a housing market crash. I believe in the future, for the next maybe 3 years, even longer, depending on a foreclosure crisis, there's going to be buying opportunities. So I am all about holding your liquidity, strengthening purchasing power, and taking advantage of loan programs right now. Not foolishly. So if it's me, I'm going to get a loan and I'm going to save my liquidity to possibly get an even better deal down the road. Here's Deuster. Question: what key events need to happen for rates to come down? Horrible things in the economy and inflation to go down. Specifically on the political side, I can't do it. I can't talk politics. I told people, like, guys, I'm not talking politics. And people are like, no, you just did. You read a Fox News article. I'm like, I just picked that article. I shouldn't have read the Fox News article. I'm sorry. I got roasted for reading a Fox News article. Can you believe that? I was like, they're like, you can't trust them. They're lying. This is wrong. I was like, but there's another 20 articles on this. Stupid Travis. Sorry. So I would say I'm not gonna step into that trap. We're
I'll
gonna
give
keep
you a
moving.
non-political answer.
Okay.
Just based on events, and it's historical. Once inflation is under control, rates come down. So there's obviously way more items that add into that, but inflation is the huge part of that. So when inflation is coming back under control, then rates will start dipping down. Non-political answer.
Here's the thing. You only do loans in Texas, not California. Is that correct?
Personally, I only do them in Texas, but we do have a corporate loan officer who's licensed in, I think, 46 states.
So here's a question. So this is a question on that new credit score tax. Based on how it reads right now, we don't have the policy change update. We get parameters emailed to us as loan officers. We haven't had that yet, but it reads as if it's going to apply to USDA, VA, and FHA, because it has the terms federally backed, and conventional is really of the four, the only one that's not. All right, let's see here. The new guidelines are meant for the realtors and home builders so that they can stay in business, just like the food stamp program was originally introduced to help farmers, I believe. Sean, love you, man. Thank you for all the support. He has a color logo now. He's been a member for 6 months. He's been a member, and my membership is 99 cents. And my membership, Jennifer, is mostly just me insecure and ranting and asking people for help. So you don't need to pay $1 for that. You could just watch my videos and tell. So there are income limits. There's not income limits on USDA, is there?
There are.
There are. So it's median
yes.
income. I can't believe I forgot that.
Yes.
But it's a lot. It's more flexible though. It's not like only for low income. Is that correct?
Right. It is not just for low income, but what I don't like about USDA in general is they use all of your income, whether we need it for qualifying. And I'll get just a real specific, just real quick. If you have, say you're a W-2 person and you have bonuses or extra income that you receive every single month or on a quarterly basis or something like that. If we don't need that income to qualify you for the loan, we just don't count it because it makes it easier for documentation purposes. If we don't need it, why document it? USDA includes all income of everyone who's going to live in that home. So if your mother's living with you and she has Social Security income, or your kid's living with you and they're 18 and they have a job. So a lot of times, unfortunately, people make too much income to qualify for USDA because of those factors.
Good, solid. All right. See, I threw his question up. He didn't even have to do a super chat. Johnny just did a super chat right now. Dang it. He just got me really hot in this vest. I bet you that I haven't seen his comment yet, but I bet you Johnny's comment has to do something with my vest and me being nervous. I haven't seen it yet, Johnny, but that's what I'm guessing. First question though, if I'm using my VA loan buying my first house, since it's going to be short term for 4 to 7 years, should I use an FHA first, paying small fees, and then save the VA for the next home? But I'm gonna just answer this. This is easy. No, you should use your VA loan because you're on a disability and you don't have to pay your funding fee. And you can actually use a VA loan more than once. It's called a subsequent use. You can do that. And if you're disabled, my brother, you don't even have to pay a fee. You're going to want to take advantage of that VA loan. That's my answer. Jennifer, do you want to add anything?
Totally agree.
So conventional VA loans are going to be affected not really by the new interest rate change, but by the good credit tax. Shara, she heard me. She's going to turn on the AC. That's why it feels nice in here. Actually, I feel the breeze. That's so funny.
Hi, Shara.
That's so funny. Okay, so a lot of realtors are, I'm not sure. I'm not going to fall for that. Nikki, it's nice to see you, girl. Thank you for all the support from the beginning. I haven't seen you in the comment section as much. Miss you. All right, let's see what else we got here. Okay, here's Johnny. Let's see what Johnny. All right, thank you for all the personalized financial advice. And I hope your little dog, Sunny, is so much backstory here, Jennifer. There's so much backstory here. Thank you for all the teaching us about buy boxes. He really wants me to step into a pile of poo-poo right now, and I'm not going to do it. These people are hypersensitive, Johnny. We don't want a war on our hands, do we? You want a war on your hands? These people are too sensitive. I can't use names. They will fall apart, man. They will do 10 videos about me, okay? Which is really creepy. All right, let's keep going. I'm not joking, Jennifer. This game is weird. All right, question. if there is no pushback on the new loan, is it for sure going into effect? So it's not a new loan. People have to. It's not a new loan. It's a new qualification guideline or a new what's called pricing criteria. Pricing means what interest rate you're going to get. You know what I mean? So it actually indirectly will have the interest rate higher actually because the pricing is higher. So actually, even though it's not affecting the interest rate, it is because it's affecting the pricing. Goes in effect, everything that I've read, Kim, everything I've read, May 1st. I dropped this video yesterday, Tiffany. But I'm going to warn you, okay? I read a Fox News article. I shouldn't have done that. I did not mean to be political. It was just, I don't know why. I just read the Fox News article. So beware, it is Fox News, but I'm not political, okay? Well, I'll shut up. Let's just keep going. The Duke. Okay. I'll answer this. Assumable loans, FHA assumable. The thing is, Duke, there's a lot of people, especially investors right now, pushing. I can't remember the term. I think it's as is or something like that, or what if. But basically, they're investors purchasing homes and assuming people's. They're saying they're assuming people's mortgage. It's a different term, but they're not doing the necessary paperwork to do that. So they're just taking the mortgage over and making payments. But the problem with doing that is if they're late, it's going to hurt the original homeowner, and that loan is still on the original homeowner's credit. So if you're going to do an assumable mortgage, make sure it's done the right way through an approval process with the lender. And at the final approval process, you got to make sure to get a full release of liability. If you do not get a full release of liability and that new seller is late on the mortgage, it hurts you. It hurts you. So be very, very careful. Thank you so much as well, Duke, for the super chat. Really appreciate that. All right. I think, yes, I'm at the bottom. I can't believe it. Let's see. I'm just trying to, how come prices are not going down in Colorado? Let me just put on my future. You know what? I really am tempted to pull up the Colorado map to take a look at that. No, usually when people say things, I'm not trying to pick on people, Jennifer, but it's like, do y'all have access to MLS? That's my first question every single time. Even realtors. And some realtors don't even know how to do market analysis. So I'm like, then what are you basing your information on? Your feelings, right? I'm not saying that they did that in that comment. I'm just saying, like, I'm yelling at people, Jennifer, like, get your real estate license, okay? Just for the pure fact that you know what's going on in the market, the accessing data.
Yep.
Taking over. Okay, so if you're taking over the assumable mortgage, that's also dangerous. So if I'm going to take over someone's loan and I'm going to do assumable, I'm going personally through the full approval process because as like the person buying the house and assuming the mortgage, if the lender finds out about that, and guess what? The lenders aren't doing too good right now. The 1 and 2, 3% right now they're suffering. So if they get the opportunity to call in advance these loans, I think that they may do that. But the disadvantages of not going through the approval process is that loan can call the entire loan due immediately. Cindy, I'm petty, Cindy. I'm trying to be better though. All right. Appreciate you, Cindy. I'm so sorry I shouldn't have said that. All right. Question. Thank you for your time. We won't be much longer, Jennifer. From the bottom of my heart, I know how busy you are. Thank you.
No problem.
Do all types of mortgage loans no longer have a prepayment penalty? I am thinking of financing to keep some liquidity, but I would like to pay a 30-year mortgage in 5 years. I'm just going to answer that right now. If it's a QM mortgage, like normal FHA, conventional VA, USDA, you cannot have a prepayment penalty on a QM qualified mortgage. You can on brokered products. This one's for you, I think. How much power do lenders have to set rates and fees? Can they lend below market rates? Jennifer?
I think, I guess the answer is I think we don't have a lot of control. We have some control. And we cannot really lend under market rates unless we want to not have a profit, right? Because lenders' profits are based in their fees, their rates, the structure of how they do everything. So if we were to do something under market all the time, then we would just go bankrupt. So I think there's some control there based on what we offer versus what, and it's very complicated on how all that is structured. So I would say we have some control, but if we did it under market all the time, we would just go out of business tomorrow. So.
I like what you're saying. I have a really important question here. I wanted to stop everything I'm doing. I actually started on YouTube with a fishing channel, and I put my heart and soul into this channel. I mean, the cinematography Let me show them real quick. This is for you, Elijah. Here it is right here. Boom. Okay, this is Spartan Tackle. I'm going to warn you guys right now. Okay, the last few videos, they're a little racy. Okay, this is the community, the different type of community. I'm talking some trash. All right, so it's a little racy. There's some a little bit of rap music. Okay, that's what I was feeling at the time. When I edit these videos, I'm emotional. Like I'm feeling it, right? I'll shut up about it. But if you guys want to look at my other channel, it's Spartan Tackle Fishing. This is actually where I started. Pretty big sharks here. It's all catch and release. We don't kill the animals. It is catch and release. I really love it. I haven't gone in so long. I've been working like a maniac. Okay. Oh, talk about if you can. Does it flood in parts of Pearlands?
So flood insurance the cost of it is going to depend on what your elevation is. So there are areas of Pearland where you're not in a flood zone, number one, but if you are in a flood zone, it's very small. So it could be $700 a year or something, but there's other areas that could be $3,000 a year. So it just depends on where it is and the history of the property and the elevation.
Okay. I like it. Thank you, Melissa. Thank you. And where's Dave at? Oh, my man. I don't know how I got this wrong, but again, brother, thank you. And I realized I didn't put up your question. That was "Don't move to Texas" question. I feel like such a loser. Thank you again, brother. What do you do for a living, man? You must be balling out, man. You don't have to keep tipping me like this and doing this for us, but I definitely appreciate it. I live in New York, Travis, and bought the person behind me this dude, he actually did it, man. They stopped me. I'm in the parking lot and said they can buy their own coffee. So I'd rather send it. No way. What? Oh my God. Are you serious, dude? He must be joking. If that really happened, man, that makes me so sad. So he's saying that he took my advice. I don't know if he's joking. He bought the person behind him coffee and then they stopped him in the parking lot offended that they bought. Dude, like, you must not be in Texas. If someone that to me, man, I'm thanking them. I really hope he's joking.
Yeah.
I really hope he's joking. So he's saying, I'm not going to do that again. I'm going to give you a super chat instead. I hope he's joking. That would be so messed up. I feel responsible. Oh my gosh. I take my kids fishing for sure. Let's see, guys. I'm gonna finish this up here. Oh, I got another super chat. I'm gonna start finishing this up, Jennifer. I think we covered a lot of grounds here, and this is something, y'all, that we may do every Friday. I have to be really careful, Jennifer, because I don't want to give people the wrong impression of what I'm doing here. Right? I believe in caution. I believe right now the house market's a falling life, and I've told you that. But I understand people buy for various reasons. I'm just saying. I got another super chat. You guys stop with the super chats. Yeah, I'm sweating like crazy. Even with the AC on, share us all that. Anyways. Hello, waiting for appraisal results right now. I studied comps and they are $10,000 to $15,000 less than the sales price. If the appraisal comes in at the sales price, can I fight the appraisal? You don't want to. Yes, you can fight the appraisal, but you don't want to fight the appraisal if you're the buyer. You want, as a buyer, I have to be careful during the negotiation process. It's kind of like in a normal market, it's not been normal. If the appraisal comes in low, usually you get the house for lower. So if the appraisal comes in high, it really, the only benefit of the appraisal coming in high if you just bought a home is knowing that there's equity in the house. Sorry, Jennifer. All right, I'm gonna go through quickly here, you guys. If I had $400,000 to buy a house or invest into the stock market, why would I buy a house and deal with the maintenance tenants than just putting that money into a high dividend yield ETF? Agreed. And I'm sorry, I'll do a mortgage question, but why did I just pop my butt? Why did I just do that? What's wrong? Sometimes there's something wrong with it, but first of all, I don't know about the stock market, and he has such a great point, and that's why investor demand has been hit so hard. People are having real hard issues cash flowing unless they have down payments, right? But if you can't cash flow, there's no point in investing in real estate per se, right? There's people chase future equity, but I don't really believe in chasing future equity most of the time. So y'all know that I debanked a lot of my money and I put it into high yielding assets, not high yielding, but like savings accounts. I'm playing the treasuries right now. Even that concerns me. I'm so sorry, Jennifer. Where's
No,
this
you're fine.
other? I think I. Oh, okay, okay. Do not answer my super chat question. She's not letting. He's not. All right, Rick. Let me pull that one up again.
Okay, I don't have to talk.
Okay, here. Let's try this again. Go ahead. Talk.
Oh, on this one. Okay, yes. So he's right. If you're the buyer, why would you fight it? That means you might have to pay more for the house. If you're the seller, then of course you could. Now, I will tell you, and I actually just did one. I haven't had a low appraisal in a long time, but I did have one last week, and they all agreed, or they all thought the property should be valued at more. Well, the comps they supplied were no better comps than the one he already used. And what people have to keep in mind is that appraisals are done through appraisal management companies in our area, at least. I don't know if it's everywhere, but here in Texas, they're done through appraisal management companies. So when an appraisal comes back and it's short compared to purchase price, they automatically have a chief appraiser review it. So two people's opinions are telling you that it's $10,000 to $15,000 less if it comes out on appraisal. So it's not just one person's opinion like it used to be. It's at least two people. You can protest it. There's a certain procedure that we use. We have to get additional information and explain why we think it should be higher. And then we submit it, and then they come back and say yes or no based on whatever criteria. The one that I just did was actually $15,000 low. And based on his explanation and all the comps he used versus the comps the agent wanted to use, it made more sense that it was actually the value. And unfortunately, this deal actually fell apart because the buyer was not going to pay anything extra, and the seller was a total stickler, and he was not going to budge, not even $1,000. So in that case, it actually did fall apart. But most of the time, like years ago when we had appraisal issues all the time, almost, I would say probably 99.9% of my deals were worked out because the buyer and seller realized, hey, this is the number. Whether I like it or not, it's the number. Let's come to some agreement that's acceptable to both of us.
Solid. And let me know that answers your question, man. And I didn't mean to not let her talk. I thought I answered it. My apologies. He did a super chat. I apologize about that, my friend. And I do appreciate your support. So let me know. I just want to make sure that answered it for you. I want to show you guys real quick. Let's do a quick market update, Jennifer. I want to show the viewers where we're at with the 10-year. The 10-year has made some rebounding upward. Remember, I have had such good luck with doing lives and the 10-year going up. The 10-year tracks mortgage rates. So I know that sucks for you, Jennifer. I know that. I'm so sorry. It's like a double-edged sword. I know it sucks,
Yep.
but rates are going up. 10-year. Let's see if Mortgage News Daily updated yet from yesterday. No update yet on that. So that's a little bit. Stock market's still sideways. It's a little bit down. All right. Real quick, look at Cindy. Look at Cindy. Y'all. I feel responsible for. So Cindy was going to pay for the order behind her, and it was a $45 order. I'm so sorry. I'm trying, man. I'm trying. I can't win all the battles, but Cindy, good job. I don't know if she paid for it. Did you pay for it still, Cindy? I'm sorry. Back to business. Let's see here. Be nice, Melissa. I see you, girl. I see you, girl. Let's see here. Wow, I've had people buy me coffee. Oh, here's a good one. All right, talk about NSF fees and how that impacts mainly people with low credit.
That's a really good question. NSFs are not good at all, but it depends. So just because you have NSFs on your bank statement does not automatically mean you won't get the mortgage. If we can explain it with a decent explanation as to why it happened, and maybe it was just one, then you probably okay. But if you have a history and there's, whatever, $300 worth of NSFs over the last 6 months, then they're going to know you're in some sort of financial trouble. A lot of times we see negatives on a checking account when there's a savings account attached to it and it just didn't transfer over for some reason. Those are no problem. We can explain those all day long. They had the money just in the wrong account. But if it's a checking account and you have all these NSFs, it's going to make it a lot more difficult because it looks like you're in credit trouble.
All right, real quick. Wait. Oh, here it is. She did pay for it. I owe you $45, Cindy. Oh my gosh, I can't believe that. There was another question here. I just lost it. Oh, Rick. Okay, so a little bit more clarity on Rick. So he's the buyer. So, he was worried about it not coming in at value, like the reverse, like undervalue. Oh, can I answer this?
Yeah, yeah, yeah.
So Rick, I want to answer this because I actually teach classes on this. I've been teaching classes on how to fight appraisal value for what, 4 years? Jennifer, do you like my classes?
Oh yeah, the appraisal class is a good one.
I love that class. I made that class myself. It's approved through the state of Texas. If the appraisal comes in low, there is an opportunity to rebuttal the appraisal. It usually has to be done through the lender because usually the lender is the client. So usually a good idea is to have the realtor provide comparable sales to the loan officer to fight it. In order to do that, you first have to have the appraisal back to see what comps they're using versus what comps they're not using. Okay, but yeah, I don't. The appraisal gap thing is crazy. So I hope that answered. Again, man, I appreciate your support. Sorry I didn't answer that too well. All right, guys, I think. Oh, let's do this last question. This is it. We're gonna leave here in a minute and we'll sign off. But they only go 2 months. So that's right. But the thing is this is about NSF fees. Some bank accounts show the total amount of NSF fees during the year.
Yeah, that's correct. Almost all of them do.
So you'll get burned.
Yeah.
You got to be careful. They only look at the last 2 months of bank statements to verify your down payment or any compensating factors like savings or assets that you're using for the loan.
Right.
Yeah.
If you look at your statements, is that I can't read that. Nictree? Nidacree? I don't know how to pronounce your name.
You know, I'm with the slow reading group. Don't do me like that.
Look at your statements. And usually there's a little like a summary section on the bank statements that shows history of the account. And there's usually a history of NSFs. And if there's a dollar amount there, that means that you've had NSFs in the past. Even though you may not have them on the current statements, it will show what they were.
Yeah. Very good. Very good. Okay. This is going to be our last question, y'all. This is going to be our last question. All right. Big question. What are the average current DTIs you're seeing lenders approve since tightening started via lenders? I'm not seeing DTI change. Go ahead and answer that.
Yep. DTI hasn't really changed at all. It's really going to all come down to your strength as a borrower. Conventional is a hard stop. You cannot go over a 50% DTI on a conventional loan, period, end of story. Sometimes you can't go over 45 depending on how weak the rest of your file is. FHA, we have a lot of leeway. VA, we have a huge amount of leeway because VA, again, like Travis said before, they look at residual income, which has absolutely nothing to do with your DTI in terms of the way they calculate it. So VA, we have the most flexibility for DTI, FHA the second, and then conventional is a hard stop at 50. But again, we look at the whole package. We don't look at just the credit or just the DTI or just this or just that. We look at the entire loan application to see the strengths of all of it. And that on FHA and VA will determine how high you can go on that DTI. I've had FHA, actually I had a VA guy 2 weeks ago. We were at like a 65% DTI because of his residual income. And it was fine. He can afford the house. It's just his DTI is a little bit off. So.
Yeah. Very good. Very, very good stuff here. Oh, whoops. Don't know what happened there. Very good stuff here. Sorry about that. Jennifer, I just want to say I appreciate you. You guys, a couple things. If you guys have any questions about loans in Texas, specifically to you want more details, that's Jennifer's contact information down below. I got her cell phone there. I got her email there. Now, I don't make any money off of Jennifer. I don't make any money off of Jennifer. I trust her. She's an expert loan officer and she's calm. And y'all, I can't tell you, normally if you're a genius loan officer, you're a complete wreck. That's why I am who I am. It's the loan officer in me, you know? And also, guys, I just want you to know from the bottom of my heart, I did take off my vest during this live. So I don't know if you guys noticed that I've taken off my vest, but I have taken it off. You guys probably noticed this was super dorky. But anyways, let's see here. Oh my gosh. Let's just do this last one. This is crazy. Like if there's an environmental claim on title, it's an issue. That's all I could say right there. Like I've had that happen maybe twice where we pulled title, something came back on title. It was an environmental lien and it actually, we couldn't close. What do you think there?
Yeah, I would actually kind of like to address the should they question. So we don't have, well, we do, but not very often do we have sinkholes here. Our issue more here is flooding, right? We have areas that flood all the time. And personally, as a buyer, I would never buy a house that's flooded 3-4 times because you know it's just going to happen again. Why would I put myself with that kind of risk to lose everything? You know, yeah, you can replace your stuff, but you know, what about your photos and all your things that matter to you? I wouldn't do it. So, you know, sinkhole, I would assume is probably the same way. I wouldn't take the risk in my personal opinion. I just wouldn't do it. But if you're okay losing that type of thing and redoing the house when it happens, then, that's a risk that you're willing to take, then do it. But, personally, I think that is just too high of a risk.
All right. Thank you. Thank you. Thank you. I don't know if it's going to be an ongoing thing, but I'm pretty sure most people didn't see when I took off. It doesn't matter. It's so dorky. Vegas, I'm going to donate this $5 right here or more. I'm just going to throw the dice. And the next time I go to Starbucks, I'm buying the coffee for the people behind me. You guys, one more time, let Jennifer know how much you appreciated her. You guys give her, one more thank you to you, Jennifer. I know you got a tremendous amount of things. I know there's probably a bunch of fires you got to put out, and
my phone's going a little nuts over here.
Is it going nuts? I'm so sorry. I know how popular, but there's the contact information. Do you want to say anything else before you go?
I would like to, first of all, thank you. I am a calm, reserved, quiet kind of person. And so being on camera, used to never be easy for me, but having you on there is really helpful. So thank you, one, for inviting me, and thank you for sharing me with all your people out there. It sounds like you have a great crowd that follows you, and just really thank you. I'm here to help, whether you guys are buying now or not. I'm here as your resource. So don't think you can't call me just because you're not buying a house. I want to be your resource. Education is our number one goal. So that's what I'm here for.
Awesome. And Jennifer, would you be willing to do this maybe every Friday? So I want to do this because, I get people, Travis, you're not talking about the solution. Even though I talk about the solution all the time, I have over 600 videos. So I can't get upset at people like, Travis, why don't you talk about this? It's like, well, in my head, I already talked about 30 videos deep.
Right.
I think it's really important to I want to take a time where it's just only education. It's not any sensationalism. It's not what's going on in the world. As far as all this drama, it's just, how does this process work behind the scenes? Let's talk about the boring, very important stuff. So hope we could do this every Friday at 8:30. That would be amazing. I think my viewers would really like that. Let me know, guys, if you would. John, he knows. I feel comfortable because that breath, the jet, blah, I can't talk. The vest isn't compressing my lungs so I can breathe. Anyways, so ridiculous. You guys, I appreciate you. Jennifer, stay with me, okay?
Okay.
All right, guys. Now, I didn't say this yesterday. I had a little bit of kickback because I didn't say this. I was so disgusted with that article I read yesterday. I didn't say this. But anyways, guys, if you're out there investing in real estate, you already know. I wish you luck, and I hope you win. So there it is.